This is Macro Horizons, episode 376, Evolution of Employment, presented by BMO Capital Markets. I'm your host, Ian Lyngen, here with Ben Jeffery to bring you our thoughts from the trading desk for the upcoming week of June 1st. And as the BLS labor market update quickly approaches on the macro horizon, and uncertainties abound, we're reminded of the time-tested adage. When one is out of work, the unemployment rate that matters is 100%. Wonder how that applies to AI. Less or more energy consumed? We'll have to ask. Each week, we offer an updated view on the U.S. rates market and a bad joke or two. But more importantly, the show is centered on responding directly to questions submitted by listeners and clients. We also end each show with our musings on the week ahead. Please feel free to reach out on Bloomberg or email me at ian.lyngen@bmo.com with questions for future episodes. We value your input and hope to keep the show as interactive as possible. So that being said, let's get started. In the week just past, solid ADP weekly jobs figures combined with reasonable auction receptions, the inflation update, and the ongoing developments in the Middle East. If nothing else, the message was consistent in the uncertainties that are on the macro horizon. At the end of the day, we continue to watch the Treasury market chop around in a range that has become increasingly familiar. While there's certainly the potential for a sustainable deal from the Middle East, there's an increasing question of credibility. When we take a step back, a deal to keep traffic flowing through the Strait of Hormuz seems to be a logical path forward, although clearly reaching consensus on this has proven challenging. With this backdrop, we expect that monetary policymakers are going to remain apprehensive as the economic data unfolds over the course of the next several weeks. This isn't to suggest that there isn't a building consensus to be incrementally less dovish than was the case prior to the war. Rather, we anticipate the messaging to be more consistent with a balanced approach to the Fed's dual mandates. Now, at the end of the day, that doesn't imply that the amount of rate hikes that have recently been priced in for 2026 necessarily resonate from our perspective. In fact, we maintain that any time that more than a full rate hike is priced in for the December 2026 meeting, that should be considered a fade. Ultimately, we continue to see the Fed's most reasonable reaction function to hawkish developments to be delaying the resumption of normalization. That being said, a rate hike should not be completely off the table, but the path to get to a rate hike is being underappreciated at this moment. Specifically, we would need to see the unemployment rate at current levels or below over the course of the next few quarters. Inflation prove stickier than will most likely be the case, and nominal wage gains, or something fresh from the fiscal side, contribute to consumers' ability to chase prices even higher, comparable to what we saw in 2022 and 2023. Our base case scenario certainly doesn't assume that this is going to be the outcome, but we would be intellectually dishonest to say that it is an impossibility. We don't expect that there will be a collective rethink of this approach on the part of FOMC members, although we're certainly open to the idea that by signaling a less dovish stance, the Fed might be attempting to let the market do the heavy lifting toward tighter financial conditions, which would allow the Fed the opportunity to keep rates unchanged while having the upside or the benefit of tighter financial conditions at a moment in which near-term realized inflation is on the upswing and medium and longer-term inflation expectations remain uncertain. And of course, this all continues to unfold with the unknowns created by the geopolitical tensions, not just those in the Middle East. Now, we haven't heard much in terms of the trade tension between U.S. and China over the course of the last few trading sessions, nor have we heard much from Latin America. At the end of the day, however, even in the event of durable progress in the Middle East, there are plenty of unknowns in key hotspots throughout the globe.
Without any real top-tier economic data this week, which has frankly been a theme for the last several weeks, trading in the treasury market and the stock market and commodities markets was broadly dictated by sentiment around the war in Iran and the ongoing blockade of the Strait of Hormuz. Coming in from the long weekend, the impressive rally we saw in both bonds and stocks was a function of optimism that both sides of the negotiating table were getting closer to a deal, and ultimately what we saw transpire on Thursday was headlines around an agreement, or at least a memorandum of understanding, that could potentially lift the blockade and implement a 60-day ceasefire as the finer points of the U.S.'s nuclear demands for Iran are ironed out in the coming months. Purely from the market's perspective, the most consequential aspect of this potential development would obviously be the lifting of the blockade, and the fact that we saw crude drop to $90 a barrel, more or less, represents an important change in terms of how investors are interpreting the balance of risks around the situation in the Persian Gulf going forward. Now, $90 a barrel isn't the $70 a barrel where oil was trading before the conflict began, but it does help moderate some of the upside inflationary tail risk that helped get 10-year yields to 470 last week. Now that we see 10s trading back just below 450, we'll argue that at present there is a bit of an equilibrium of optimism that there might be an off-ramp approaching that would return the flow of oil through the strait to more historically normal levels.
And an agreement at this stage is reasonably important because we haven't seen producers completely draw down their inventories, and so we haven't reached that proverbial reckoning for physical delivery, which might have forced futures to catch up with what's going on in the spot market. So as we think about this proverbial off-ramp, it is coming at an opportune moment, which implies that the global economy might be able to sidestep more material fallout from the developments in the Middle East. That being said, monetary policy makers will still need to contend with the potential for pass-through of headline inflation to core consumer prices, and the degree to which that has occurred will be topical over the course of the next several months. As we've seen in Europe, some of the initial increases in headline inflation have moderated in the recent month, which implies that monetary policymakers will have a bit more flexibility, although the bias in the ECB remains toward the timing of the next rate hike, as opposed to the Fed, which has, at least according to the FOMC minutes, shifted from a dovish bias to a more balanced bias. This balanced bias will presumably be reiterated at the FOMC's June meeting, which will be Warsh's first opportunity to set the tone at his initial press conference. Our expectations are for no significant change in terms of the policy rate, and while Warsh might be laying the groundwork to make some changes on the communication side, we're still expecting an update of the SEP, and the dot plot will likely reiterate the market's wait-and-see assumption. The Fed funds futures market continues to oscillate between pricing in rate cuts and pricing in rate hikes and pricing in rate cuts and pricing in rate hikes. And at the end of the day, we still consider the Fed's most reasonable, hawkish response function to be simply delaying further potential rate cuts into Q1 2027 or beyond. Now, a lot of the stable monetary policy rate assumption is based on the notion that the real economy will continue to demonstrate the degree of resilience that we have seen in March, April, and May. This dynamic has been reinforced by the fact that equity valuations continue to reach record highs, which have contributed to easing financial conditions and, of course, flowed back into the wealth effect, which has helped the consumer. On the inflation front, the April core PCE figures came in at 0.2% on the month-over-month basis, slightly below the consensus. And while real personal spending was positive, it increased just 0.1%. That's notable, especially given the fact that personal income during April was flat, which reflects a deceleration as tax refund season came to an end.
And the aggregate of the latest data and the economic fallout of oil prices has translated through to what has probably been the most significant monetary policy developments since the April FOMC decision. Ian, you touched on the fact that unlike other central banks, where the debate has shifted to the timing of the next hike, The most important change that we've seen in terms of the Fed has been a shift in the collective consensus on the committee in favor of the formal dissents that we saw at the April meeting, specifically removing the easing bias from the formal language of the statement and introducing more symmetry around the distribution of risks as to the direction of the next policy move. We heard from Waller last week on exactly that topic. Others opined this week that there isn't a great deal of evidence that monetary policy is still in restrictive territory, and so if the committee's view is that policy is currently at neutral, then it only makes sense to introduce more flexibility in both directions to respond to however it is the economy performs over the balance of the year. We know that Warsh is concerned about AI and what it means for labor productivity and the overall health of the jobs market, with obviously plenty of upside risks to inflation, given what's taken place in the energy market so far this year. One client conversation over this past week introduced the notion that there's a risk that what is happening in oil is masking what's actually occurring on the demand side of the equation and what that means for consumer price growth. What we mean by this is we know that historically central banks are reluctant to respond to supply shocks and don't want to tighten monetary policy into an inflationary environment that is driven by higher input prices. But given what we've seen in terms of retail sales, in terms of a still strong labor market, and generally a growth backdrop that's not on fire, but is hardly cooling in a material way, there is the risk that the Fed is disregarding signs that perhaps the economy is reaccelerating and there's more and more upside risks to inflation from the demand side of the equation, given that there's a reluctance to respond to what's going on the supply side of the equation. And so a strong or accelerating underlying economy that would be introducing more upside risks to inflation anyway, had we not seen what's played out in the Middle East play out, begs the question, what would happen if we get a normalization in crude prices, let's say back to $70 or $80 a barrel, we make it through to the fourth quarter of 2026 or early 2027, and all of a sudden realize that the labor market is retightening and that wage growth is reaccelerating, which obviously has inflationary implications that the Fed would need to respond to.
And that's a scenario in which it's not difficult to envision the next move from monetary policymakers being a rate hike as opposed to a rate cut. But there are a lot of net positive things for the real economy that would need to occur between now and then, not least of which being a convergence instead of a divergence between what we're seeing in the establishment survey from the BLS and the household survey, with the latter showing consistent declines in employment, whereas the marquee headline payrolls number continues to grow, in some cases, well above expectations. The week ahead does contain May's employment report, and we think that this will be pivotal for the broader macro narrative. Here, the market is looking for roughly 100,000 jobs to be added to headline payrolls, and that combined with an unemployment rate which is seen unchanged at 4.3%. Recall that in April, while the unemployment rate on a rounded basis was unchanged at 4.3%, on an unrounded basis, we actually saw nearly 0.1% increase, while the labor force participation rate dropped 0.1%. Said differently, there are some cross currents within the employment data itself, which suggests that the resilience narrative could quickly deteriorate if we see a few consecutive weak employment reports over the course of the next several months. It's certainly top of mind as we move into the summer.
And also providing a reason for angst is what we're seeing play out in terms of consumer confidence. Last week, we saw the University of Michigan measure revised lower to its lowest level ever, and the Conference Board figures have been similarly uninspired. The main driver for the dim outlook is unsurprisingly inflation and higher prices of everything, but especially gas prices. As summer gets underway, driving picks up, and consumers are much more frequently faced with the experience of looking at gas prices that are now closer to $5 than $4. And so it's that feedback loop that would ultimately flow through to spending habits as a whole that would risk being exaggerated by any further uncertainty around the labor market. It's not difficult to envision a situation where disposable income is being increasingly siphoned off, no pun intended, by gas prices. And if we add into that increased uncertainty around the security of one's employment situation, it's that environment where growth would take a significant leg lower. Now, as we've discussed, an unemployment rate, even at 4.2%, hardly represents a catastrophe in terms of labor market slack, but the trajectory matters, and so does the departure point in terms of how households are withstanding the burden of higher oil prices.
So in short, what you're saying is we're worried about spillover from the oil market. Pun intended. In the week ahead, we expect that the first week of June will be characterized by a return to trading the fundamentals. Admittedly, the backdrop of fluctuations in energy prices will pose the risk of overshadowing some of the fundamentals. However, we're far enough into the conflict and we've seen enough demonstrated strength and resilience on the part of the U.S. economy that the beginning of the May data cycle warrants a nod. The first major data release will be Monday's ISM manufacturing data for the month of May. Here, the market is looking for a solid 53.2 read, which is notable given the headwinds facing the manufacturing sector, higher energy costs, higher input costs across the board. So the fact that the market is still expecting a well above 50 read speaks to resilience in the sector. We also have the JOLTS update. Although this data is for the month of April, as it is typically the case, lagged by a month. Let us not forget ADP on Wednesday morning, and ultimately, the labor market anecdotes will culminate in the May non-farm payrolls print. The current consensus is for a 95,000 increase in headline payrolls. This is expected to be accompanied by an unemployment rate which is unchanged at 4.3%. Recall that there's been a notable divergence between the establishment survey and the household survey. The household survey has been consistently printing negative, while headline payrolls has surprised on the upside. We'll be monitoring this divergence as it implies that we could be at an inflection point for the overall health of the labor market at this important juncture for the macro outlook. Nominal wages will also be relevant, and here investors are expecting a 0.3% increase in May's average hourly earnings. For context, that is likely to underperform what realized inflation did during the month of May, which once again refocuses the market on concerns regarding real purchasing power for the U.S. consumer. This issue is particularly topical for the bottom two quartiles of consumers, which have seen the prior wage acceleration translate into far more benign wage gains, even as headline inflation has continued to move higher. On the monetary policymaker front, there are a few Fed speakers who are likely to offer opinions about the overall state of both the labor market as well as the inflation profile, to say nothing of the forward risks associated with developments in the Middle East. In the run-up to Warsh's first meeting as chair of the FOMC, we would not be surprised to see increasingly divergent opinions stated, if for no other reason than to help level set expectations for the incoming Fed chair's ability to quickly build a consensus that would result in a near-term rate cut. We don't see any viable path to a near-term rate cut this summer, especially given how elevated gasoline prices are as we begin what has traditionally been the driving season in the U.S. The theme is most likely to shift from higher prices at the pump to cutbacks in other non-necessity consumption areas. We've reached the point in this week's episode where we'd like to offer our sincere thanks and condolences to anyone who has managed to make it this far. And for those keeping score at home, the next Treasury market holiday is just 3 weeks away. There are definitely chocolates on their way to SIFMA. Thanks for listening to Macro Horizons. Please visit us at bmocm.com/Macro Horizons. As we aspire to keep our strategy effort as interactive as possible, we'd love to hear what you thought of today's episode. So please email me directly with any feedback at ian.lyngen@bmo.com. You can listen to this show and subscribe on Apple Podcasts or your favorite podcast provider. This show and resources are supported by our team here at BMO, including the FIC Macro Strategy Group and BMO's marketing team. This show has been produced and edited by Puddle Creative.
The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries. For full legal disclosure, visit bmocm.com/macrohorizons/legal.